Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's April 3rd, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Have to start off with the NCAA tournament. Been insane. Well, actually, you know what? The first two rounds were really bad. I actually was tweeting that at Frank Curzio. Got to tweet a lot more. The first two rounds, no real upsets, right? No Cinderellas, maybe one, not too many. It's kind of boring. Lots of blowouts. Then you had the next two rounds. Now, holy cow. I mean, Duke, Virginia Tech, Virginia, Oregon, Purdue, Tennessee. You had Purdue, Virginia, which was an amazing game, although I do think the Purdue coach kind of lost that game for them. You know, Carson Edwards, what an amazing performance. I mean, 40 points. I think he scored 40 points in two games. One of the first people to do it in a very long time in the NCAA tournament. But the guy was clearly out of gas at the end of that game. I mean, his only points came from a banker off the three-point bank shot with like 3 minutes left. And then he had that turnover at the end. But his whole team was stagnant. They would just, every time Carson passed the ball, they gave right back to him. Pass the ball, gave right back to him. And he was unbelievable, but at the end of that game, they had 2-3 guys on him. I mean, you just backdoor him, just pass it. You would have had layups and, just call timeout or something. That guy was so tired, and he had that turnover at the end. It was just such an amazing game, but he was out of gas with 3 minutes left. And, they still fed him the ball. I thought it was an opportunity. They have a good team to really another great three-point shooter on the team. But what a game, right? I mean, a little bit of luck there for Virginia. Pushed it into overtime. Then you had Duke, Michigan State, another great game. Gonzaga, Texas Tech, Houston, Kentucky. I mean, every one of these games really close. You had Auburn blowing the doors out on North Carolina and then beating Kentucky. I mean, Kentucky, I thought Calipari did a great coaching job. I don't think Kentucky was that good at all. And the fact that beat Houston was a great game. And then when, they had a shot, actually, going to overtime. But at the end of the day, listen, it's Auburn looks really good. They have one guy that got hurt that's out, but I can't remember a better Sweet 16, Elite Eight set of games ever in the tournament. I mean, that's how amazing those games were. Now we look at the tournament, which I broke down. Is Duke losing should come as no surprise to you. I told you they can't shoot threes, they can't shoot foul shots. Very rare. Those are two qualities you're going to see in every past champion in the NCAA tournament, being able to shoot threes, being able to shoot foul shots, and they couldn't. I think it's 85, close to 90% of their points come from the paint. I mean, they should have lost against UCF. They didn't play that good against Virginia Tech, and then finally they lost to Michigan State. Texas Tech should not be a surprise either. That was one of my sleepers, although I thought Michigan matchup would be tough for them, and they destroyed Michigan. But I did say if Texas Tech scores over 70 points, they're going to win the tournament. And they scored 75 against Gonzaga. They only need 63 to beat Michigan, but they held them to 44 points. And the best defensive team in the league. And they won whatever it was, 12, 13 games leading up to the tournament, but lost in the very first round. I don't know if they were 1 or 2 seed in the Big 12, but they lost to West Virginia, which is not a good team. I think it was, West Virginia. And they just fell off the radar for everybody. And they beat Kansas by like 25 points in that run, and they just looked fantastic. But they lost that game, and everybody was just like, wow, 3 seed. Again, off the radar, especially being in that tough bracket with, Gonzaga and Michigan. But, for me, I did put money on Texas Tech, $100 to win the bracket, which that'd be $550. I also have another $100 on to win the whole thing, which would net me about $1,700. And I think they have a good shot. But when I look at the whole NCAA, even Michigan State, I think we had a lot, I was analyzing this stuff, but where I really got wrong is North Carolina. Because, I mean, Auburn really smoked them. They played great, but that was my NCAA champion. I thought they had everything. They really played terrible. They totally got outplayed. It wasn't even close, that game. But having North Carolina as a winner just destroys everything, every single bracket. So that's on me. But, Texas Tech should be in there. Michigan State should be in there. You shouldn't have too many surprises there. Virginia as well. Virginia, guys, is a really, really good team. I think Virginia is probably the best team that's left. The team could always play D. We knew that. But this year, their offense is really, really good. And that's where they're able to hang with Purdue and win that game. Again, thanks to a little bit of luck. That last second shot put them in overtime. and beating Carson Edwards, who's just on fire. But when you look at all the teams, again, breaking this down early for you guys, I get a lot of questions, and plus there's nothing really going on with the market other than Lyft, which I'm going to have one of the greatest educational segments in a minute. But there's not a lot going on with the markets right now. So I'm just going to finish this out, give you guys my scoop for the Final Four. Because who's going to win it all? Well, Michigan State playing with a lot of confidence, have a great D. Their offense is clicking. Texas Tech is the best D in the nation. Their offense has been great the past 2 months, under the radar. But I kind of have to go with Michigan State here. I mean, I want Texas. I hope I'm wrong on this because I got money on Texas Tech to win the whole thing. But simply because Tom Izzo, who's the best coach in college basketball, you can say, well, Krzyzewski, and these guys always get players. Tom Izzo, his team is not that great this year on paper. And they're playing like it's one of the best teams he ever had. I remember I saw them play against Kansas early on. Kansas beat them. They just weren't that good. Now they're playing with loads of confidence. You know, beating Duke, they got the momentum. So I think you're going to see Michigan State advance. The Texas Tech coach is not that good. He hasn't been there. I'm familiar with him because I'm a Kansas fan in the Big 12. But they do have a great team. On the other side, Auburn being down a player is significant. It wasn't significant for Kentucky, but I think it's going to catch up with them. Virginia. Virginia has a chip on their shoulder from last year. I kind of think if you ask any team, number one seed, that if you could lose the first round, which happened to Virginia, the first time in history they lost as a number one seed. Any team is lost by a number one seed in the first round of the tournament. But if you could ask any team, hey, if you could look back and say, okay, you lost very first round as number one seed, which makes you look horrible. Again, you're on the map, right? And then come back the next year and win it. I think a lot of coaches would be like, cool, I do that because it's really hard to win an NCAA tournament. It's really, really hard. It's one of the few sports where sometimes the best team, the great team. I thought North Carolina was the best team. They got smoked. I mean, Duke's not going to win. I mean, these are good teams, but Virginia has a really good shot of winning this thing. Yeah, I think they're going to come in. They're going to beat Auburn. Aubur's down a guy again. It's going to catch up to them. And I can tell you, it erases everything that happened with Virginia last year because nobody's going to care. I mean, people love comeback stories. I think Virginia's going to beat Auburn. I think it's not going to be close. I think they win in double digits, which is Michigan State against Virginia. And I think Virginia's going to cut down the nets to one shining moment. It's my prediction. I hope I'm 100% wrong on this, but it's not like the Super Bowl. I'm usually pretty good other than North Carolina. Did give you a couple pretty good sleepers there. But, I just thought North Carolina would do better. So, going to be a lot of fun coming up this week. Final Four in Minneapolis, where the Eagles won a Super Bowl. It's going to be an amazing venue. I was there not too long ago, well over a year ago. Lots of fun. And it should be really, really good. Really good teams, really good coaches, and it should be a good Final Four. I mean, I like it. I'm excited about it. Good teams. Nice to see North Carolina, Duke, Kansas, all those guys in it. You know, a lot of first-time teams in that Final Four, and it's pretty exciting. Moving on. Going to interview a familiar guest. His name is Jonathan Awde, who is the president and CEO, also the co-founder of Gold Standard Ventures. So this is a company I followed for many years, which made my subscribers a lot of money early on, over 300% gains. But I recommended this name several times, and we stopped out of it. So there's 2 other times I recommended we stopped out. It wasn't because the management team wasn't executing. It wasn't because the company reported bad drilling results. They actually significantly expanded their signature project over the years. It's down because the resource market has been terrible. And this stock has been down more than others because Gold Corp has a position in this company, and people worry that, Gold Corp merging with Newmont, that, they said they're going to sell non-core assets that might result in these guys, selling the stake in the company. I don't see it because they have a stronghold and have a very strong hold in Nevada, and all these mergers and acquisitions is really about Nevada and positioning themselves better in Nevada. So on paper might say, well, this isn't a core asset, but it kind of is for Gold Corp. So, the stock has come down a lot. I love the fact Jonathan reached out to me and said, hey, I want to give you investors an update. I know I've came on in the past, and I just want to tell them where we are right now. And he's going to give us, an update on the company, the catalysts that are coming up, and why Gold Standard is a great position to benefit from the next bull run in gold, which seems to have started in January. All right, it's a lot of factors, a lot of macro. Again, this is a cyclical market, guys. It seems like it's been a secular decline because it's been so long, other than maybe a period in 6 months, 7 month period in 2016, early 2016, January through whatever, August, September. And other than that, 5, 6 years now, 2011, 2012, it's been really ugly for this industry. But there are factors, especially when it comes to the macro part of it, which, Jonathan and I are going to get to and right at the beginning of the interview. But there's a reason why I'm bringing on a lot of mining companies for you, some of the ones that I like that I think are going to benefit tremendously when this market turns. And I just want to position you guys in these names because these are names I followed for a long time, management teams I followed for a long time, and Gold Standard Ventures is one of them. So you're going to hear from Jonathan in a minute. Then later on, my educational segment, I'm going to break down one of the craziest companies in the market right now. That company's Lyft, which IPO'd on Friday, came out blasting first day of trading. Now it's trading below its IPO price of $72. So I'm going to break down this name for you, let you know if you should be buying on this pullback or avoid the company altogether. Now, guys, if you're interested in learning how to research companies, I'm talking about real research, not, hey, the P is 11 and the company's trading a book value, so it's a buy. No, nonsense. If you're interested in learning how to dig deep on companies, really, really go into the fundamentals, management teams, catalysts, everything, definitely give this segment a listen. You may not agree with my call, and that's cool. But you're going to get a much closer look at the homework I do to determine whether a company like Lyft or other stocks make it into my portfolios for Curzio Research Advisory, which is more large cap, mid cap, or Curzio Venture Opportunities, which is about finding those very small micro cap companies that have huge, huge growth potential. But it's a huge process. And I'm going to dig into the research. It's going to be really cool. Again, maybe you agree with it, maybe you don't, but you're going to see why I came to this thesis on Lyft and really break it down. So guys, definitely give this section a listen. I'm not hyping this up. It's going to be a lot of research. I really looked at this company for the past 2 days, and it's going to be really, really cool when you see why. I won't even give it away whether I buy it or sell it, but you're gonna understand why that I came to my conclusion. So I'll leave it there. Hopefully I built that up enough for you guys. But first, before we get to the education segment, let's get to my interview with the president, CEO of Gold Standard Ventures, Jonathan Awde. So Jonathan, thanks so much for coming back on the podcast.
Pleasure to be here, Frank.
Well, let's talk about the macro first before we get to Gold Standard Ventures, your company. I would say about 70% of our file probably knows about it. I've recommended it before. But we have a lot of new people on our file. But before we get to Gold Standard Ventures, I want to talk about the macro, which is always important because I don't care who was on your board. I don't care what the discovery was or whatever. The market's been horrible. It's brought down every single company over the past 2 years. But we've seen a little bit of life, right, in the gold industry where, the macro's getting a little bit better, at least to start the year. We're seeing the Fed come out and say, hey, no more tightening. We're probably going to wind up easing again. Inflation kind of in check. But it seems like there is money going to gold right now. Gold prices are rising a little bit. What are your thoughts? Is it different this time? Is it kind of the end of, it's a cyclical market, right, that you guys are in, but it doesn't seem like it's cyclical. It looks like it's the secular decline. It's been so long. Is it finally starting to turn? What are you hearing from the people you speak to in the industry?
Yeah, look, I actually think the backdrop for gold going forward, it's setting up really well. I think you've got, the broader markets, approaching all-time highs now again. And, you had a lot of volatility in the Dow and the S&P late last year. The Dow kind of peaking in that almost 27,000 and went down to just below 22, and now it's sort of back to 26.3, and it looks like it wants to make a run at those new all-time highs. So money's, still kind of flowing back in, but historically, when you have the last kind of round of corporate buybacks, that's when you typically get that push. And then when that subsides, I wouldn't want to be owning the broader market. And I think that the Fed signaling that it's not going to be tightening this year, and now there's a really divided street where a lot of people are looking at, well, maybe they start easing rates next year.
Yeah, and that looks like it's going to be the case next year. Now you've been traveling a ton, just like a lot of people in the industry, because you had PDAC, which is basically the largest conference, mining conference, BMO conference too, which is in South Florida. You also went to London and Geneva. So even my friends in the mining industry, like the past month and a half, 2 months, it kind of like, that's when they travel, they meet investors. And in the middle of this, what are you seeing, even at some of these conferences where we're looking at the majors starting to merge, right? And Barrick tried to get involved with Newmont. You have Newmont Gold Corp. What are you hearing on that end? Because one of the things that has been a concern for investors, what I'm hearing out there, at least from big investors that want to invest in the space, is when these guys are merging, they're saying that, hey, you know what, we're probably going to sell some of our non-core assets. And I also know Gold Corp has a position in your company as well. But people are looking at this and saying, whoever Gold Corp or Newmont has a stake in it, they may sell. It's adding pressure. What are you hearing out there? Is this? I mean, you have an amazing asset, but it's probably non-core considered for them. Well, maybe not necessarily, but is that a worry? Is that a concern? What are you hearing out there from that point of view? Because that is definitely a concern. What I'm hearing on my end.
Yeah. So first of all, I mean, you had this unprecedented wave of large scale mergers. You had Barrick and Randgold merge, and it was, John Thornton, the chairman of Barrick, has done a phenomenal job of cleaning up the balance sheet. Basically merged with Randgold to get arguably the best mining CEO on the planet, and Mark Bristow. And we were at the BMO show, and on the first day of the conference, Barrick goes hostile on Newmont, and during that time, Newmont was already in the process of trying to acquire Gold Corp. So Bristow was trying to do two things by going hostile on Newmont. He was trying to A, derail Newmont's attempt to buy Gold Corp, and B, and arguably more importantly, force Newmont to do a joint venture in Nevada. And 2 weeks later, Barrick cancels his bid to acquire Newmont, and they announced the joint venture where Barrick is not only the operator, but has 61.5% of the JV. So Mark Bristow in 2 weeks did what no other mining CEO for either Barrick or Newmont could do in 20 years. So it's unprecedented. And then, to segue into your comment about what does this mean for Gold Standard, what it means in the short term is that there is more uncertainty. It's at first it was, was Newmont going to be successful in acquiring Gold Corp? If they were, what would, the share position that Newmont will be inheriting from Gold Corp and Gold Standard, what are they going to do with it? And then it was the joint venture. What assets are going to be in? What assets are going to be out? Gold Standard's land package is within the area of interest. Gold Standard's share position, we don't know whether it's going to be in the JV or outside of the JV. And yes, there are going to be assets that come out of this, but I think the most important theme is that Nevada is home base for gold exploration and production. It has the largest deposits in the world. It's the best jurisdiction. And it's a lot of this big fight was over Nevada. So I think there's going to be a period of uncertainty, and we've already been through that for the last couple of months. I think you're starting to see investors say, well, wait a second here. Fundamentally, what has changed? So, if you look at our chart, October 12th, we were the number one performer in our peer group in 2018. The next day, Gold Corp announces their disastrous Q3 earnings. Their stock goes down 20% in one day. And the market says, oh, well, Gold Corp can't buy them right now. It has to be, at some point in the future. Where Gold Corp was very supportive. They had bought 7.5 million shares out of the open market. They filed that in July. They came into a funding in late September, early October at 205 Canadian. For us, nothing had changed. And then it was the GDXJ rebalancing, which we got caught up in again, going, ultimately from a 1.2% weighting to a 0.5 over the course of 2 years. And then you had the whole BlackRock rumor that they were going to go from an active fund to a passive fund. And then two other active funds having their mandates pulled and almost 10 million shares of selling into the market. So I think there's, while it's been challenging, it's been a challenging 6 months. I think there's incredible opportunity for generalist money to come in, or even specialist funds to look at stories that maybe they looked at a year or two ago and thought, these valuations I don't like. And now you can get these same sort of opportunities for 30 or 40% less than they were trading at, where some of these companies, some of these assets have been significantly de-risked.
And you brought up something interesting, Jonathan, because that's why I was going with this, where the fight between these guys is about Nevada. And why don't you 100%. Talk more about your company, your location, railroad, fourth window, because just for people who aren't familiar with Gold Standard, why don't you give us that scoop? Because I think that's important to the whole thesis here.
Yeah. So Gold Standard has amassed the second largest land package in the Carlin Trend behind Newmont. And we have an oxide discovery called Dark Star that we're moving along. That's high-grade oxide, really good recoveries, low strip. So it's a project that Gold Standard can build on its own. And it is the highest grade undeveloped oxide deposit in the state. If you look at Newmont's portfolio in Nevada, the only true oxide deposit they have is Long Canyon, and they bought that back in 2011. So there has been a massive depletion of oxide ounces in Nevada, and Gold Standard, when you look at Dark Star and Pinion, is sitting on between 2.5 and 3 million ounces of oxide ounces, and it puts us in a position where we can control our own destiny, where we are not held hostage by having to use the processing facilities that belong to Barrick and Newmont. And we have a satellite, a number of satellite targets and deposits that we've been drilling and advancing and moving along. So we think this has the beginnings of making a mining camp where you have multiple pits, multiple, declines, hole in the grounds, a big operation where you can get that scale. And it's, a 45-minute drive from the town of Elko, Nevada. We have power to the project. We've got water. Everything's there. And, despite the fact that we've been drilling on this project for, 7 or 8 years, there's still a significant portion of this project that has been untested.
And when you look at your project here, because I've been following this story for, I would say, over 5 years now, right? 6 years since we know each other. And it's done incredibly well. And I know the entire market has come down. But when I'm looking at it now and where you guys have taken it, I mean, could you talk about that compared to where you started, where you are now? Because when you look at the valuation, trading at the same levels you were 2 years ago, 3 years ago, whatever it was, and what you've accomplished over that time. It's not like, hey, these guys have, with our market where it's more about earnings, right? So if earnings are going to decline, your stock's going to decline. But it's almost like, you don't have earnings, obviously, but the discoveries, the quality has risen significantly while your valuation has declined. Could you take us through those numbers maybe over the past 3 to 4 years? Because where you are now is the best position you've been in terms of drilling results, exploration, but yet your valuation is probably lower than it is over the past 2-3 years.
Sure, and that's a great point. So, if you look at a chart over the last 5 years, we had, Dark Star was what really got us out of the depths of the 2013-14, bear market, and we are now trading below where we were when we made the discovery at Dark Star. And when you talk about de-risking, so when you make a discovery, the next thing the market wants to see is, okay, well, how big is it? And then they want to see, well, when you tighten up the drill spacings, is the continuity going to fall apart? Is the grade going to be more erratic and spotty? Continuity is fantastic. And then for an oxide deposit, the higher the recovery, so when you put it onto a leach pad, a big open pit, you put it onto a leach pad, how much gold are you going to be able to get out? Anything north of 70% is very good. We're getting 85. So, and then during that time, Oceana Gold has bought 15.5%, Gold Corp has bought 14%, and Kinross owns 4.9%. So it's rare to see 3 seniors in your registry. We've got an excellent list of institutional shareholders, and we've unfortunately been faced with some of those shareholders having redemptions and some of that money leaving the space or having their active mandates yanked from them. And then, unfortunately being caught up in this GDXA rebalancing. But you look at since October, the stock was $2.40 Canadian, and it is now, basically 140 Canadian. So, to say that it's on sale and on discount is an understatement. And when you look at what's actually happened, I mean, there's nothing fundamental that, to support the stock going from 240 to 140, except that we've had what I just outlined, GDXA rebalancing, a couple of active funds going passive, and the perception that the competitive tension has been lowered. Now, I think that's true maybe for the short term, but I don't believe that anything fundamentally has changed about the asset. If anything, it's gotten significantly better.
So let me ask you this, because when it comes to people investing in your company, they want to see catalysts, they want to see drilling results. Talk about that, because you do have an aggressive drilling program, I believe, through at least first half of 2019, which provides catalysts, right? Especially if those drilling results are good, especially with your stock at this level. So, what are some of the things that investors, if they want to invest in your company, say today, that they can look forward to over the next 3 to 6 months?
Sure. Look, we just finished up our phase 1 program at Darkstar, and we moved those rigs over to our Lewis project. And, the goal of the Darkstar program was to keep expanding it both north, west, at depth, and to the south. And, the results we put out over the last 2 months support that thesis. We've got another, I think, 12 or 15 holes left that we have to announce. We're waiting for assays back. So we're very excited by what we're seeing, and our expectations for Darkstar remain high. And we moved those rigs over to Lewis. So Lewis is our project. It's about an hour west of Darkstar, and it's immediately contiguous with the Phoenix Fortitude mine that belongs to Newmont that will be in the Nevada joint venture. And the interesting thing about Lewis is that there's a 250,000 to 300,000 ounce historical resource. It's all oxide. It's plus 1 gram, which for oxide is high grade. That at some point, Newmont or this joint venture will have to lay back on to expand their pit. So it has not only strategic value, but it's got a lot of exploration upside, and that's why we're going back in there. We picked that one up through the acquisition of a public company called Battle Mountain Gold, which closed in April of 2017. Very rare to get 6,000 acres next to a core operating mine that belongs to Newmont or Barrick. And, we think there's a lot more for us to do there. And so that's, we'll have some drill results there. And then we're just finishing up all of the network and the modeling on Darkstar and Pinion to come out with a PFS in the fall. And that's going to be, I think you'll see, the cost at Darkstar in the lowest quartile. You'll see a very manageable CapEx, and you'll see an internal rate of return, likely in that 40% plus level. So I think, again, these are not final third-party numbers. These are Gold Standard's internal numbers. But I think that when you look at what Darkstar is compared to anything else that's new or oxide, Darkstar stands on its own. And that's what people care about, and I think we're going to be able to deliver that. And then we start up, the next phase of drilling here over the next sort of 3 or 4 weeks, and we're going to look to get back into some of the targets that we had some success on, and we feel that we're on the cusp of a discovery or that particular target turning a corner, like Jasperoid Wash, like Dixie, like LT. We have a new target called LT where we have 10, 15 grams in oxide at surface in golden soil, golden rocks. Looks really interesting. This one's about 1.5 miles northwest of Pinion in the same package of rocks. So we've got a lot. We've got a lot to do this year, and yeah, it's Frank, it's been a tough market for 7 years where you've had pockets of money flowing in, and kind of short-lived. But for the most part, if you look at a chart of gold, it's been a pretty bumpy ride. But, back to the macro picture real quick, Frank, no one is really talking about an all-time record monthly deficit in the U.S. of $234 billion. $234 billion. Now, that's bigger than the GDP of some countries. And I that's not sustainable. So I think the story for gold is really starting to come into its own, and I think over the next year you will see gold start to continue to go sideways, but and then go higher. I think that key number is 1370, and if we're able to get through that, I think you'll see generalist money piling in there. And I think when the Fed ultimately turns and starts to cut rates, I think that's when you'll see that parabolic, springboard move where gold is now suddenly 1450 or 1500.
Yeah, the market's been so terrible. It's just, and I'm a believer. I think gold is going to come back. I'm just curious, though. I'm not too sure if it's the safe haven, right? I mean, everybody says, well, with deficit, it's more of a safe haven. I don't know. It seems like the bonds, treasuries are more of the safe haven, but it just seems like fundamentally with few discoveries and where it is a cyclical market where gold has been, it just, right now, it just the landscape is positive for gold right now. I think if you're going to look over the next 18 months, but it will be interesting because I think we both thought that like a year ago as well, right? Last time, I thought we were ready to.
And I think that's what you're seeing. You're seeing that skepticism in the market with generalists saying, you know what, there's been so many false starts in gold. I'd rather pay, 5, 10, 15, 20% higher in some of these equities than, be early and be wrong again. So that's why I think that more investors are looking at gold and saying, you know what, should gold break through that, 1360, 1370? I think the real number is 1400 for a lot of generalists to really start piling in. And again, if you look at the average generalist portfolio, I mean, over 90% of Americans have no exposure to gold. So forget 10%. I mean, 5%, 2.5% of, generalist money flowing into the gold space. The gold space is a very small industry when you compare it to other industries. So it won't take a lot of capital for this thing to get really exciting.
Yeah, no, it definitely makes sense. And the last thing here too is I saw your presentation that your drilling program was for you budgeted $27 million to drill 2018, 2019. You already drilled in 2018 and a little bit in 2019, and you have $18 million on the balance sheet. So is that enough to cover your drilling costs for at least the next 6 months, 9 months, or is it, hey, we may look to raise money later on depending on the drilling results? I just wanted to see where you are at that.
At some point this year, Frank, we will go back to the market. We'll see what our corporate shareholders want to do before we proceed forward. But really, the drilling at Dark Star and on the project won't resume until kind of that second half of May. It's not going to be as big of a program this year as it was last year. And then we're the only other spend, Frank, is to move this thing to a PFS. And that is just doing a lot of the engineering work. We're doing what's called HPGR, which is a kind of a crushing technique where we think we can extract a lot more gold and get better and improved recoveries. So we're doing that, and that work should all be done in sort of June, July, and looking at having a August, September a PFS. So I think we're going to have a smaller program with a couple of rigs and really big step outs. We're going to be drilling some holes underneath Dark Star. So at Dark Star, you've got this nice oxide cap, and we're starting to see high grade, underground grades into the sulfide zone underneath Dark Star, which is a really exciting pattern to see. You see that in all the big deposits, in the Carlin Trend, the Cortez, where you have that oxide cap, and then you transition into a sulfide zone. And we're seeing that at Dark Star, which is really exciting to see. So we've got a couple of deeper holes planned there. And we are also going to go back into our North Bullion, which is on our, the same flagship project about 6 miles to the north. There's a large endowment there, and we think it's all connected to the Rain District to the north, which currently belongs to Newmont, but likely will go into the JV. So interesting times, Frank. It's but I'd seriously, I wouldn't want to be anywhere else in the world but Nevada. Nevada's fantastic. It has its challenges, but I think from finding an elephant and being in a safe jurisdiction, I think that is really important in today's environment.
Yeah, it definitely makes sense. And I guess we'll leave it there. And Jeff, I respect the fact that, you reached out to me and said, hey, you know what, here's a good time to come on. The price is right. A lot of times the CEOs of companies reach out to me when their stock is really moving higher, and it's not always the best, to get our investors and people that I know into these stocks. But I really appreciate that because I know you guys are working hard, you're doing the right thing, and I've been a part of that and know your company for well over 5 years, which I did very, very well on it early on. So I really appreciate you coming on.
I also know that you're a value guy, and you understand cycles good or better than anyone, and sometimes being a bit of a contrarian is you're taking, a bit of leap of faith. But, I think as you outlined earlier, look, I think we've de-risked this project and this company significantly. And I think we're well positioned as this market wants to move higher.
That sounds great. So listen, Jonathan, thank you so much for coming on and giving us an update. And I'll probably talk to you in a few months from now.
Thanks, Frank.
Yeah, it's great stuff from Jonathan. I've known him for a very long time. And Gold Standard Ventures is a great company. We've been with me for the last 3 years, recommended twice, and we stopped out for losses. But before that, we really recommended. I was able to get into this company very, very early, meet Jonathan, meet the management team, Dave Mathewson, the geologist, and it did fantastic. I think it was 2010 through 2012. We made a lot of money for subscribers. Saw it come down. I didn't think the market was going to be that bad, and I tried to re-recommend that, I think in 2015 or so, 16. Or maybe it was a little bit after that. And again, the stock just fell. So, really due to market conditions. But right now, look, it's an awesome company. I would wait on it right now. I wouldn't go in there and purchase it. It seems like it's cheap at these levels. I'd like to see some kind of uptrend because there is, I asked them fair questions and said, hey, what about the Gold Corp investment? Gold Corp is, 10% plus owner in the company. And, if they decide to sell that stake, that's going to be significant. There's people who are worried about that. So, they're not worried about that. They are in Nevada, so maybe it is seen as a core asset, not a non-core asset for a company like Gold Corp. But it is right now. I want to see a little bit more momentum in. I want to see more people coming in. I want to see those shareholders who own it increase their positions and stuff. That's something I would really like. But Nevada Exploration I brought on recently, and also On Resources, interviewed the CEOs of those companies and executive teams for those companies. Those are much better position right now to go a lot higher, I think. Gold Standard Ventures, listen, keep it on your radar. It's a fantastic company, but it's going to need help with the market. It's going to need help with the market. People are a little worried right now. It's one of the companies. Again, he said it had an amazing run till October, but then it came down, and it's one of the few companies that have been trailing downward as the rest of the market's kind of been going up since January. If you look at a lot of charts, especially of Nevada Exploration, you're looking at On Resources. So this is one I want to throw in front of you. I think it's a name that you have to keep on your watch list, but I'd probably wait. I want to see a few cows. I'd like to see better drilling results over the next 3 to 6 months. I'm probably getting after they raise capital because the drilling results are weak. That stock's going to come down. If they raise capital, they're going to have to do it at even more of a discount, and you probably get it a lot cheaper. If not, if they report good drilling results, that's fine too. I mean, the stock's going to go higher, but I'd rather buy it 10, 15, 20% higher, knowing that you have those fundamentals, those drilling results below you that they just reported, which will provide a base. And, I don't mind buying that 15, 20% higher, considering it's down tremendously off its highs. And now that you have, fundamentals behind it, and you have probably, those drilling results are really good, guys, not to beat this to death, but you'll probably see a lot of the major shareholders, which they have very, very quality shareholders as the largest shareholders in Gold Standard. They'll probably increase their position. Might be a better chance to get in. But I want to thank Jonathan for coming on. Awesome guy, someone who I've known for a very long time. Now, let's get to the educational segment. We're going to break down Lyft. I'm breaking this down. So I'm getting lots of questions on it. And I even, saw a bunch of old friends last weekend, and one of them was like, "Hey, what do you think of Lyft? I got to buy Lyft." I'm like, be careful buying Lyft. This is when, of course, it came out and went to 80 something or whatever. So they IPO'd on Friday on the NASDAQ. Stock opened up at $87. So it was up 20% from its opening price of 72. Which gave the company a valuation of like 28 billion, something around there. But over the past few trading days this week, Lyft started to fall, and it fell sharply to under $70 a share, which is below the IPO price. So it's a 20% decline within the first week of trading. That's not a good sign for any company who just IPO'd. Nevertheless, one that's extremely popular, since this is a service many investors are familiar with and even use. You're familiar with Uber, you're familiar with Lyft, competitor. Now, you're looking at the stock coming down, and it's a name that you're familiar with. I put this like in a Facebook category. When they came out, individual investors are like, well, I could purchase this through my E-Trade account and my, whatever account you have now that, charge you $3 in trades, Robinhood, wherever you want to go. Anyway, now that it's pulled back, she uses pullback as a buying opportunity. And you know what? Let's break it down. Because I'm going to go over a lot of stuff with you here that's really good, really quality. You're not really going to find this anyplace else. At least I haven't read anyplace else. And let's break it down. So we have Lyft says it captured 39% of the market in the U.S. as of December 2018, which is up from 22% in December 2016. That's significant. They said this new growth comes from new riders, drivers, as well as more frequent rides from existing users, right? Now, they said that they have 18.6 million active riders. I guess, how they define active riders is riders that have, probably use their service multiple times over the past month. And they have a little over 1 million total drivers. Now, again, they captured 39% of the market. But I read an interesting report because Lyft is basing their numbers in terms of market share on a consulting company called Rakuten Intelligence, Rakuten, Rakuten Intelligence, right? That's the study that came out and said, hey, they captured 39% market share. Rakuten is a big investor in Lyft. I don't know if anybody knows that. So again, they're saying Lyft has 39% market share in the US, but there's another consulting firm out there that tracks this data as well. It's called Second Measure. They're fully independent. They don't have a stake in Lyft, right? Just report the numbers. According to them, Lyft only has a 29% market share, and they say Uber has close to 70%. That's a very, very big difference. I mean, you're looking from 29% to 39% of a market that big, that's a massive difference. But they're reporting, their 10K came out in their prospectus that they own 39% market share. Yet, the company that doesn't have a stake in them, who's fully independent, right? The consulting for Second Measure says it's 29%. So to me, that's just one red flag. Because if the data from Second Measure is accurate, then Lyft only gained about 7% market share over the past year, not the 17% that they've been telling everyone that people have been buying the stock off of, especially as they launched over the past week, an IPO. When I look at the numbers, last year, Lyft reported a net loss of $911 million. Okay, that's up 32% from the previous year. Sales during that period came in at $2.2 billion. Okay, that's double from the previous year. So right now, even after the 20% decline in the stock trading around 70, we're looking at a company that's trading at 11 times sales. Okay, the average company S&P 500 trades at 2.5 times sales. Now, being expensive doesn't mean you should sell the stock. If that's the case, you would have never bought Netflix 10 years ago. You wouldn't have bought Apple 15 years ago, and you certainly would have never owned Amazon. Okay? You have to see that growth. Now, when I look at their growth, they're expected to grow sales north of 50% next year, which is good. After the capital raise, they have over $5 billion in cash. That's also good because they're really going to need that cash. Because the company's been aggressively raising prices for its services into the IPO. So right now, the average rider pays $36 per trip. That's how much they pay when they get into, on average, is $36. So I wanted to see how much that was compared to, over the last year. Just the last quarter, they raised prices by 10% leading up to the IPO. And over the past year, they raised prices by 25%. So you're raising the price by 25%. You're reporting a much, much bigger loss. You're generating more money. Why isn't it filtering down to profits at all? You may say, well, Frank, Lyft has pricing power. They're able to raise their price 25%. They're still seeing demand, at least as of, their report. Let's see if it goes further. Not they, significantly raise prices. But I don't think they have as much pricing power as you think. I mean, Uber is cheap as well. Much, not much cheaper anymore, but cheaper than traditional taxis. But if you're going to continue to raise prices, there's a level where you can't raise them anymore because then you're getting back to where taxis are charging. And I could tell you with that price differential, not people that, I use Uber. I take taxis sometimes from the airport because it's a lot easier from the airport than walking like a half a mile to that space where they have, Ubers and Lyfts. And it used to be 50%. Now it's probably like 20%. And I have actually taken a taxi that was cheaper than an Uber for the first time. And that was about 2 weeks ago. Might have been a situation, might have been rush hour, might have been whatever. But I'm just saying that you don't have pricing power where you could raise. There's going to be a level where you raise where people are like, I'd rather just take a taxi. So I don't know how much pricing power they have. They did a good job raising it into the IPO to get enough demand on it. And everybody, being able to sell this thing to the market was great. But when I look at Lyft specifically, and even really both companies, they're paying more per driver. They have to incentivize their drivers, right? That they're paying more to drive during peak hours. Most people don't like driving during peak hours, but hey, if there's incentives, it's almost like overtime. I don't work overtime, I'm not going to see my family, but if you pay me time and a half, yeah, okay, it's worth it. That's what they have to do for their drivers right now. And this costs at least Lyft a lot of money. And they need to do this because imagine trying to get a Lyft at 5 p.m. in New York City, and then they're like, well, we're not going to be there for 20 minutes or 30 minutes. I mean, you're going to jump in a taxi in a heartbeat if it's available. So they need to incentivize their drivers, which increases the costs. Now, I'm looking at a company, and they even said they're not projected to generate profits in the foreseeable future. And again, that's okay if you're growing. So Netflix, especially Amazon, over the past decade plus, right? Those stocks are up tens of thousands of percent. And people said they're expensive, but they were growing. They captured the markets that they were in. They're in massive markets. They're industry leaders. You look at Amazon, whether it's cloud has been unbelievable. Retail, everybody knows, was more than 50% of sales of anything being sold in the U.S. goes through Amazon. I think I read a stat like that, which is insane. But when I look at Lyft, I don't know if they're going to continue to grow like they're expected or what they're saying. Because the losses right now at Lyft are insane. I mean, they lost close to $1 billion last year. That's net operating profit after tax, which is 40% more than the $700 million they lost in the previous year. And remember, they're raising prices. I don't know why that loss accelerated so much. And I can't remember an IPO ever coming to the market while losing that much money. I can't. Maybe you guys can. I looked it up. And Snap was losing a couple $100 million. There's a couple of others, but not $1 billion. I haven't seen that. And that's pretty insane. Again, these losses are expected to continue. This is the company talking. Which means that even though sales are expected to jump 50% next year, it's not translating into profits for some reason. And that's pretty scary for investors looking to buy this stock, trading at 11 times sales right now, which is super expensive. Now, you look at their growth. Uber has more of an international presence. They don't. They're going to try to expand outside the U.S., but again, that's going to cost a lot of money. And since you're losing $1 billion annually right now, that $5 billion plus in the bank doesn't look so attractive anymore since, again, it's not like more money is coming in. You're losing this money. It's okay to spend, and the results of that spending are increasing sales, which they're doing, but it's just not filtering down to the bottom line at all. That's what scares me. Now, there's something else that's interesting is no one really talking about with Lyft. Because Lyft discloses that it has 46 million in restricted stock units. That represents about 20% of the shares outstanding. And they have another 13.8 million of employee stock options, which represents about 5% of the shares outstanding. So together with the RSUs, right, restricted stock units, and employee stock options, they're worth over $5 billion. A lot of this stuff is hidden. You got to find this stuff. But it's important to understand if you're thinking of investing in this stock, because you're going to get the shit diluted out of you by 25%. That's a big dilution. Nobody's talking about that. Now, what does that mean, dilution? Well, in short, that means if Lyft's market cap is around $25 billion right now, if you push in that $5 billion, that makes their market cap more like $30 billion plus. And what does that mean? Well, the stock's currently trading at 11 times sales as of 2018. But if you include that dilution, it's trading close to 14 times sales. Pretty incredible. People aren't really talking about that. But I'm looking at a company that did everything it can to create as much excitement. They raised prices. They just, coming out with this offering, it was just, really, really hyped up. But it's positioned for a lot of the insiders to make a lot of money. I mean, especially with restricted stock units, employee stock options. These guys do very, very, very well on those. So looking at the valuation, it's at insane levels right now. Even the company grows sales by 50%. They're spending tons of money to gain market share. It's not resulting in profits. They're in a competitive market that seems to have low barriers of entry. That's why I don't see how you have pricing power here. You have Juno just entered the market. Bubble, which uses first responders as drivers, which is pretty cool. You're always going to be safe. Not that people have heart attacks or whatever when they're riding in cabs all the time. But I guess, in today's day and age, everybody's really, nervous, scared of everything. But when your model is, hey, we're going to raise prices here, right, which they're doing, you open the door to the competition. And there is a limit on how much you can raise prices, because if you start charging more, than taxis, and people are going to start jumping in traditional taxis again. So it's interesting. The market share is a little skewed. I don't like the market share number. I don't like the fact that, they're losing a ton of money and said, hey, we're going to lose money forever. So you're able to raise prices. Your sales are going to go up, and by 50%, you're still going to report really big losses. But besides all of this, right? So aside of everything that I just mentioned, if I make no sense to you at all, that's fine. That's cool, whatever, right? So I want to dig deep into this thing. But so far, what you learn, it seems like it's pretty crazy to buy Lyft here. But this is the most important part of research, I think. Forget fundamentals, forget technicals, forget all that garbage. You got to use your common sense. That's what's going to separate you from everybody else. When you're looking at common sense, when a company IPOs, you have all individual investors get excited. They could buy Facebook for the first time, through the brokerage account, Twitter, Alibaba, and now they could buy Lyft and get excited. You need to understand an IPO is a liquidity event for the people who bought the stock at much cheaper prices. Those are the shares being sold to the public, to you. Shares these guys had probably at $10, $5, even $1. And they're selling them to you for $72, which that went up to $87 and then, fell below $72 in the first week. You may say, well, Frank, aren't these guys locked up for at least 6 months? Some of them. There's plenty of ways you can hedge your positions by shorting the stock. Believe me. And you may say, well, Frank, how do you short the stock? Isn't that illegal since you need to have possession of shares? And the shares, usually offered an IPO, it's a small float that's being sold during the IPO. It's mostly locked up by the underwriters. Not true. Not true, guys. There are ways to short a stock during that IPO period, right when it comes out. As long as you know where those shares are. Yes, it's called naked shorting. It's supposed to be illegal, but it's done all the time as long as you know where the shares are. And they do. Believe me, you got guys at Morgan Stanley and Goldman Sachs shorting the crap out of this thing right now. And they should, because the people shorting are the people that are in this stock at much cheaper prices that want to lock in those gains. It makes sense. They probably know the stock's going to come down tremendously over the next 6 months. And when the full lockup period ends, a lot of these guys who bought it for, 10, even up to $20, $25 a share, they're going to look to dump this thing immediately. So as of yesterday, I looked at the short position. 6 million shares are short right now. Oh, how'd that happen? How can you be short? That's $450 million. I think this number is going to go much higher, even though it's super expensive to borrow to short for Lyft right now. But you're talking about people, the investors are in this name at $15 and under. Hey, they're looking to lock in their profits. They don't care how much it costs to short this thing, to borrow. Again, once that 6-month lockup period ends, watch out. Because I can tell you something, Lyft better report blockbuster numbers in the quarters ahead, which 90% of new companies who IPO fail to do. Because it's not easy going from a private company to a public company. It's a whole new ball game. Reporting, you have to report every quarter, every number, the conference call, the lawyers, accountants, regulation, compliance. You know how difficult it is? You're a private company that nobody needs to know anything about you other than the people that are investing in your company through the private rounds. Now you have to report everything, every number. It's not easy, especially for a company the size of Lyft, which has a $25 billion valuation right now. And by the way, that $25 billion valuation, guys, this doesn't make you skeptical. That's 70% higher than what the company was valued 9 months ago. Well, last time the company raised money in the private markets, and I think it was around June, it was private, 70% in 9 months. What happened with this company to be valued 70% higher at the markets? I think Google might have came in at that round. Good for them. They came in for that round. A year later, boom. You think Google's not looking to lock in their gains or trying to short the stock or just trying to hedge their position here, which means they're going to short it? Believe me, the guys at Morgan Stanley and Goldman Sachs are very, 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 very smart. This short position is going to get bigger and bigger. So guys, be careful buying Lyft here. I mean, they really need to do a ton to fit in their crazy valuation. Is it possible? It's possible. It is. Maybe the company does. They take more market share. They kill it. Maybe, their losses go from $1 billion to $300 million. They say they're going to be profitable in a year and a half from now. They could do it. It's just based on what I'm seeing right now. That ain't happening. It ain't happening. You don't have much more pricing power before they start losing business to other services like Uber, generating massive, massive losses, which they say, hey, this is going to continue for a long time. And it's just crazy that this is a company that's spending more money, able to increase sales, yet that money's not able to filter to their bottom line. We need to see that to change first. And I'm betting against them. I don't think it is. I think it's a really hyped company. I think the investment firms, the underwriters did a great job to hype this up, to get this thing launched. And when you look at the underlying fundamentals, even the companies that are covering this thing, one put a sell on it with a 40-something target price. Another one's a neutral with, an $80 target price, which they can't even justify. But how do you justify this thing going to $100 here? Maybe it does. I don't know. Maybe they find a way. Maybe, I don't know, they come up with, their first autonomous vehicle just for ride sharing, whatever it is. I don't know. But a lot has to happen for this company to really go higher from here. And I don't see it. I really don't see it happening. So that's my analysis. Let me know what you thought. FrankCurzioResearch.com. Again, it's not just P ratios. It's not just fundamentals. It's not just technicals. It's common sense as well. Looking at all the details, looking at the options, looking at how much money these freaking guys are making. And they're trying to sell you the stock to individual investor, basically trying to cash out after these guys made huge, huge profits. So the same thing with Facebook. Facebook came down tremendously. Would it come down below 30? I think it hit 29 from its 50-something IPO price. But Facebook figured it out. They figured out how to make money, how to raise money, advertising dollars. They figured it out and the stock took off. I don't see Lyft figuring it out. I don't. So guys, I would avoid it. I wouldn't buy it here. I think it's very dangerous. Again, I could be wrong on this name, but man, I would definitely wait till they report next quarter, their first quarter results, or the second quarter, just to see where they're at. Because that's when the company's allowed to announce their projections. Right now, you're not supposed to announce your projections. I went through this with doing our Curzio equity owners. Okay, you can provide the numbers of the past years. You're not allowed to project. So now that they're a public company on their call, now they're going to project. People are going to ask them, okay, what is your projection? What do you see for the next year? And they're going to say, this is what we see for the next year. I'm curious to see what they do see for the next year. How much they're going to lose? How much sales are going to increase? I think it's going to be a lot less than what people think on the sales side, and I think those losses could accelerate. Anyway. Guys, hopefully you enjoy the podcast, that segment, my NCAA bracket, which I'm done with now, right? I won't talk NCAA anymore. But again, there's not too much going to market. We're in between periods here with earnings season and stuff like that, but it's going to start getting really busy again. And we'll focus on really, really good stuff, the economic stuff, bringing on great guests, give you lots of stock picks. So, again, anything you guys need, give me a shout, Frank@CurzioResearch.com. That's Frank@CurzioResearch.com. So thanks so much for listening. Appreciate, as always, all your support. And I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.